All right, let's get started. I want to welcome everybody to the family. We got a lot of new people here, a lot of new students. I'm very excited. But I want to tell you a little bit about myself and a little bit about a story before we move forward. A lot of you know that Heidi and I like to go to the beach every summer. We stay out there a few months at a time. And some of you that are in Florida or know the area know that we had a monster storm in July about 2 weeks ago. And we were held up in the condo for 2-3 days. Wind was blowing 30-40 miles an hour. We were stuck in there. I was going a little stir crazy. Internet was down. And finally, the storm dried up, sun broke, and I ran downstairs. As soon as I could get out of that place, I was going stir crazy. And I went on the beach, and there was a lot of devastation. There was a lot of sailboats turned over, catamarans, jet skis toppled over on the trailer. All the lawn furniture was gone. And when I got to the shoreline, I looked both directions, to the left and to the right. And to my amazement, there had to be, 10 million, 1,000, I don't know the number. It was insane. Starfish laying on the beach. And they were just everywhere. I was standing there around my ankles. And, Heidi was dragging the baby behind me. And I bent over, started picking them up, started throwing them back. I picked up one, I tossed it. Picked up another one, tried to skip it, threw it in there, like you skip a rock. Grabbed another one, skipped them in there. I just started throwing them in as fast as I could. And Heidi came up to me. She finally caught up with Chase. She was a little out of breath, and she goes, "What are you doing? It doesn't matter. Look at this. Look at all these starfish on the beach." And I picked another one up in my hand, and I showed it to her before I tossed it back. And I told her, "Heidi, to this one, it matters." And I tossed it back. You guys matter to me. You laid out the money for me, and now I'm here for you. What I want you to do is dismiss all the other crap that you have learned about trading for the next 4 days. And I want to be here for you. I want you to sip the Kool-Aid and just become part of something bigger than yourself. I always say this, and it's the truth. This is the last Forex market training you are ever going to need. But the problem is, if you go outside of this area, this room, this group of traders, to find solace or to find comfort, you are not going to find it. Because people don't know what this group in here knows. People think I am a quack, a nut job, a sicko, a psycho, whatever. They don't believe that what I say to be true. The fact that you join this group proves to me that you know that I'm not crazy, that maybe I'm on to something. I promise you, subscribe to something bigger than yourself, become part of the family wholeheartedly, and you will have success in this trading business. Okay? So let's get started. All right, this is one that pisses everybody off. No trading this week. I want you to stop trading for a couple of days. Money, when it's on the table, good or bad, clouds your judgment. Especially if you're losing, right? If you're in a negative open float, or if your trades are down, or you're getting stopped out, you're not going to think with a clear head. And if you make too much money, the same thing applies. You're going to be so jacked up that you're not going to listen to anything. Just turn the platform off for a few days. The market's going to be there when this class is over, I promise. And just hang on, absorb the knowledge with an open mind, and then be ready to trade at the end of this class going into next Monday. Okay? What I wanted to mention to you is that we're going to do a little something different this class that we haven't done before. I'm going to have Carr, Cam, and Granny on the last night come in and give you the market maker biases going into next week. What that's going to do is after you have the information, you'll have a first-hand idea of how to apply it for next week's market. Okay? Some of the points I mentioned, I'm asking this as a favor. Put aside everything you think you know to be true about the markets. Open your mind to the possibility there is, in fact, something going on here and that we're privy to it. Allow yourself the opportunity to have success. And something I say in my regular presentation, don't try to mix systems into this. Don't say, oh, Steve, this is great, but I like the slingshot, or I like the rainbow stochastics to add to the bottom of this. It'll really make it great. That stuff is unnecessary. Don't do any of that stuff. Just give me 4 days, sip the Kool-Aid. I promise you, you'll be happy. All right, this housekeeping slide. Usually we don't need to worry about cell phones on vibrate. I'm going to try to break about 5 to 10 minutes every hour. Quick bathroom break, grab a Diet Coke, etc. I don't put out a book or a textbook or notes. So I'm going to insist that you write stuff down or go back through the recordings and take advantage of that and take your notes then. Just enjoy the class. Kim mentioned this, but it's important. If you're a retake, don't ask questions about sections that we're not covering yet. Gloria, if you're here, don't ask me about the ADR on day one. Save that for when it's supposed to be presented. If you have questions and you just can't stand it, email them to me or save them for the very end of class during the presentation, all right? Let's not try to interrupt the flow of what's going on. All right, I want you to be courteous to your other students in the forum, in the classroom, and in the live classroom. We all paid to be here. Everybody learns at a different pace. If I get going too fast, don't be ashamed to say, hey, Steve, man, look, you're jacked up on Diet Coke. I can't keep up. Slow it down a little bit. I'll wait up for you guys. All right, I'm here for all of you. That's not some sales or bullshit. The sales part's over. I'm here for you guys. I answer emails. If you're struggling and you're embarrassed to ask me, don't be. You paid to be here. I'm here to get everybody going in the right direction and on the right track. All right, we're going to do some homework. Possibly going to end up posting it in a forum, but here's the email address the homework goes to. Steve@mmmforex.com. The guys that are having the most success, girls too, have done all the homework. Some still do homework on the weekends or on a slow night. I know you're saying, shit, I didn't pay this guy all this money to sit here and do homework. I promise you that homework is the key to success in what I'm talking about. If you can't see it in hindsight, you will never see it in real time in foresight. So the idea with the homework is, once I illustrate to you how the market makers work the market, is to go back and to make sure that you can see the stuff developing, see the levels, and see the things that I point out to you in the past. And once you can rapidly identify those things in the previous charts or in history, you should start to recognize their appearance in real time. Everyone should have gotten a glossary. If not, it is in the forum. Keep it handy for the next couple of days. I might say some things that don't sound normal. That's normal for me. The terminologies are on there. The best thing to do is tonight after class, if you're a little lost, just read over that a couple of times and get familiar with some of the things I say. That's all. All right, that's what it looks like. You should have it. Okay, some people are saying they can't see the slides. We're on the glossary page. If you can hear me but not see slides moving, everything's working on my end. I'm positive. So log off and log back on, okay? All right, let's get started. We're all here to learn how to beat the market maker and trade in line with him. All right, so to beat this guy or these group of guys, you got to understand their objectives and what they do. Their first objective is to induce traders to take a position. How do they do that? They circular trade, which means they trade between them. They trade from bank to bank, back and forth. They produce wide range swings. The swings create some type of activity in the market, even though there's really no volume behind it. Your account is of no use to him. You making a deposit of FXDD is of no use to the dealer until you click the mouse, until you take a position. So his job is to induce you to click the mouse by showing you something on the chart that gets you to take action. Usually sets up some type of textbook technical that you've read about, or a breakout system, some type of behavior to get you to click the mouse. Their second objective is to create panic and fear to get you to think irrationally. Now, I talk about the illustration as they spike the market quickly and pull away from those zones, which validates the pending orders or gets people going in the wrong way. That quick move or spike or inexplicable price behavior out of nowhere, they spike the market on a Friday afternoon right before the close. That creates a panic in you. And if you're in a position when they snatch the market away from you, that creates a panic, gets you to lift your stop and think irrationally. That irrational behavior ensures that they will margin you out or eventually get you into trouble. And finally, what the business is about from the beginning is the money. So they got to hit the stops and clear the board. And if you lifted your stop, they're going to drag the market in such a way that it forces the majority of the traders into margin issues. Because the bottom line and the most important objective is to pocket your money so they can get their Christmas bonuses. Okay? All right, am I going at a good pace? Okay. In order to beat this guy, you got to know what they're capable of doing. These slides were given to me out of a textbook in the back office in Dubai called the MetaTrader 4 Manager's User Guide. Okay, what? You're saying you didn't know they had a book? Did you think that $4 trillion is floating around without a book or some type of idea on how to beat the traders? Somebody wrote a book on how to take your hard-earned money away. The business is not random. Okay? Market makers can issue you a requote at will. You see the three buttons in the center: return, send, confirm, reject. They simply hit the reject button and you are forced to reissue your order, which in turn, the market's moving, you get requoted at the new available price. Keeps you from getting a good fill, getting a good entry. Market makers can trigger all the stops in a range. Left arrow says stop out, check the box. The right arrow, unlimited, across the board. We got X number of contracts in open float. At this price point, we want to hit the stops. They simply add that, hit OK. Notice it's in different languages. They hit it. Done. They got what they need. Market makers can toy with the spreads. You know those robots that work so wonderful in demo that are garbage? This is why. In demo, you get an aggregate of about 3 feeds, 3 price feeds. The aggregate of the 3 feeds is going to be much smoother than what you're really up against on a real account. In demo, since it's not real, they could care less about manipulating the spread, widening the spread to pick up the stops. They don't care. So what happens is you spend $97, which by the way is the refund price point for ClickBank. You spend $97 and buy a robot. Anything over $97, they got to give you a refund. Anything under, they do not. You own this robot. You put it on an account in demo. It makes $10 million in 25 minutes. You're jacked. You put your hard-earned money in the account. And then guess what? They take that little slider where the arrow is and open the spread on you. You'll pick up your buy side of the order, and the sell side or the opposite closing position side will never hit. There's a lawsuit right now, I believe it's with FXCM, that states this exactly. I think Abo sent it to me. And if I remember, someone reminds me with an email, I'll post it in the forum. Since it's a private forum, I could say the name, I guess. Can I, Kim? I don't know. The dealer is being sued for having these backside plugins and using these against the traders. Now, I want to say that not all dealers use this. There are some honest dealers out there. Usually the ones that are backed up by banks, or I know Kim and Scott represent good, clean dealers. But what I'm telling you is that this kind of crap goes on. That's why the NFA is trying to regulate this business and clean it up a little bit. Okay, did you ever open up two different platforms and notice that maybe one high of the day is 23.55 and another one is 23.57? Do you understand that the dealer can hold a price point with this plugin right here? Here's how. He can set the high, low, and close on a bar based on where the orders are. So if the dealer sees stops at 23.59, or if he sees a bunch of orders at 23.60, he simply types in the high of the bar to go to 23.59. Let's say there's stops at 55. The dealer goes, man, we got stops at 55. Let's hit 59 and clean the board. Remember I told you his third objective is to hit the stops and clean the board? This is how he's capable of doing that. Okay, let's say there's pending orders at 23.50 or 23.48 on the low side. He doesn't want to activate those orders because he might end up retracing and going back down. He will make the low 23.52 and leave the pending sitting there and not absorb those orders because he doesn't want the negative drawdown. Okay? These tools give the dealer an edge. And understanding that these are out there switches the edge back in your favor. They know who's in margin trouble. Ever do something stupid and lift your stop and get yourself flashing red and black back and forth because you're on the edge of margin? He knows this. He has the whole list of who's in call-out trouble. It's on his desktop. There's a trade designed called a straightaway, which I'll discuss here this week, to finish these guys that are on the fence and call them out and take the balance of their account. It's up to you to know the call-out level of your dealer. You guys that are overseas, certain dealers have a 0% margin call. That means they could take every penny from your account. Some have a 25, some have a 50. They could even take the front side margin that you're using to hold your positions open. You need to understand this. Understand that when the traders are in trouble and these margin call levels are on the fence, the dealer will issue a straightaway trade to finish these people off. And that's where the straightaway trade comes in. And that is the only reason it comes in, is to take the money from the traders that are on the fence and flashing red in their account. Someone's asked me if I said something about FXCM. Do you work for them? Because if you do, then I won't say it again. Oh, I had to get a sip of Diet Coke there. Market makers manage risk against the open positions. Look at the summary line on the bottom of the slide. Listen, it's a business. They're in business to make money. Send me an email. I'll talk to you about FXCM. They're in business to make money. They're not in business to see you succeed. You're in business to make money as a trader. They're in business to make money as a dealer. That's the way it works. In order to trade the right way, you have to be in line with the dealer, and he's not going to come back for Fred for his one order. They're not going to move the whole market back to get Ben. It's just not going to happen. So trading in line with these guys gives you a major edge. This is every plugin I just showed you on the account manager's desktop. Anyone that runs this platform has this. And I'm going to show you a picture of what they're looking at in a minute, or what the room looks like. This is what they see. They know everybody in margin trouble. They know the open orders. They know their open positions, how much equity they have as a dealer to work with. Listen, some of you are upset about accounts. Contact Kim and Scott at Compass. They are the IBs for a couple of good dealers. They will get you going in the right direction. All right? Enough said about that. Contact those guys at Compass. That's why they're here, to aid you guys in getting good accounts at clean dealers. Okay. The account manager's desktop. He knows everything that's going on and the accounts that he's managing. You have to understand that this is what you are up against. Guys, ever seen this before? It's been floating around. This is one of the rooms at UBS. But UBS is not the only dealer that has a room like this. Each one of those guys is managing their risk, monitoring their equity, and looking after the customers. All right, I want you to understand that this is not a game or a hobby. The dealer is lying in wait for you to make an uneducated, emotional decision such as lifting your stop loss or over-leveraging your account. If you've been kind of half-ass trading the business and treating it like a hobby, I encourage you to take up photography. It's cheaper. But if you are serious and want to trade in line with the dealer and can master the principles I'm going to show you this week, this stuff that I just showed you about the dealers should be irrelevant to you and unimportant if you could identify his behaviors and follow what he's doing. Okay? Okay, so how do we beat these guys? We have to understand where they set up their moves and what's going on. They make some trap moves. Those trap moves start at the beginning of the week, Sunday going into Monday. Edwin, check you might have to log in and log back out. Okay, look, a lot of people are saying I'm having problems. Can you, in fact, see how to beat the market maker slide trap moves? Just throw a couple of Y's up there. Don't go crazy. Okay, fantastic. Thank you. The trap moves are made at the beginning of the week. Why? They'll jam you up and hold you in open position from Sunday, Monday. The beginning of the day, 5, 6 o'clock, when they set up the channel, the market maker spread, they already have some number of jammed up traders. The beginning of the session, at London Open and US Open, there was a false move to jam up the traders in both sessions and to end the day jamming you up. The end of the session and the end of the week. Friday, they will make an aggressive move and pull back against that move to trap the traders into weekend carry. Okay, I'm trying to keep it a little slower so you can write. So think for a minute. They make the false move at the beginning of the London session. They run the trend. At the end of the London session, they will make one more extension, which is false. Then pull back, go into consolidation for the US, and then possibly reverse. End of the session, continue with the trend. Beginning of the session, hit that number again, don't break it, and come back. The end of the day, 4 or 5 o'clock in the afternoon, or if they end the trading day at noon, which a lot of times they do, the price will go back into consolidation which is the end of their day, and leave you jammed up into the next day. Now think for a minute that I've told you this, that they make these trap moves at those times a day. How many times have you sat there at 1 o'clock in the afternoon all the way into the next night, aggravated that there was no movement in the market? You got jammed up in the consolidation zone and had to sit there until the next night London Open when something started moving again. The beginning and the end of the day is defined as 5 o'clock New York. The end of the day is 5 o'clock New York. It's a 24-hour cycle. I'm going to illustrate it for you in a second here in detail. Understand that the pattern presents on a larger scale throughout the course of the week. Okay, some of you just installed the indicators. I'll give you a brief update on it. These double tracers right here. Let me grab my little ballpoint pen. I'm excited. Okay, these little tracers right here and right here. These two lines. This is Friday. This area is Sunday. This is Monday. This is the beginning of the week. The double black tracer is the beginning of the week. So here you have the week beginning. Market makers make the aggressive move to trap the traders long at the beginning of the week and then pull the market away from those traders. There's your week beginning trap move. In fact, this move just played out in most majors across the board on Monday. They made a triple top high and jammed all the traders and the bottom fell out. My traders caught that move. And I know what happened on the recent one is they made the high Friday. They came back, hit it again in Asia. And at the London Open stop hunt cycle, they hit it again. So you had a triple top high lined up with the London Open. Yes, look at the majors. Sunday, Monday. Okay. Beginning of the session. Right? I said beginning of the week. Sunday, Monday, they'll make a jam move. Trap the traders long for the week. The beginning of the session. Stop hunt in both directions, which triggers the pending orders. Right? Breakout traders, bracket this. Nice, right there, grab the pendings. They pull back, stops out those breakout traders. They hit them again. They come back, don't allow them to see a profit. Shift the zone off of those traders. Game over. You got whipsawed long and short in one session. And if you don't have the guts to come back the third time, and a lot of people do not, you're jammed and you miss the trade. Okay? So now you know when you're looking for the false moves. End of the week. Here's Friday, right? Here's my double weekend tracer. Friday, Sunday, Monday. Okay? Here's Friday. Before they end the day, they spike the low, pull back, end the week in consolidation chop. The lower level shorts are jammed for the weekend and got to pay rollover. Right? To add to the beginning of the week, they open with a gap. They didn't used to gap a lot in Forex. A couple of years ago when people got their butts kicked in equities, they started flocking over here in droves to the Forex market because of the leverage and the ease to trade. You don't have to memorize 150,000 stocks. There's a handful of pairs that you can work with. The Forex market started sounding very appealing to people that lost their pensions. Now, because there's more volume, these guys added a gap to their arsenal against you. So what I'm telling you is, in not so many words, or in too many words, don't carry your trades over from Friday into Sunday, Monday. Not necessary. If I told you they're going to jam you on Friday and leave you trapped, and you caught this M in the U.S. session and you shorted here, and you see the hammer to the low and it pulls back, take your money off and call it a good week. Okay? End the day in consolidation, end the week off of the high, 25 to 50 pips to jam the traders, depending on the pair, and I'll talk about that in a minute. Okay? Good stuff. Another Friday example. They went up to the high. Friday, Sunday, Monday. Here's your formation. Here's our entry in our group. This might have been a scratch because you have a big entry bar. We might add a pass on that. I know Jim Nicholson got in right there, though. Okay. If this bar is too big, this is a pass. This is a no entry. Okay, now, here's the gap I talked about. This looks like buy the dips in an uptrend, right? So people got jammed up all in here. Friday, they closed, they stuck them because people thought the market would rally at the end of the day, right? Whatever the philosophy is. They gapped down, hit the stops that were all in this range right here. And all these guys that were stuck long in here, they gapped them right out, with this, hit their stops. Now, the shitty thing about the dealer that he can do about that is this. If the dealer closes at a price point on Friday and he gaps down 100 pips or 80 pips or 50 pips and opens, if your stop was 5 pips below the candle, he gives you the fill at 45, minus 45. How can he do that? I had an order in minus 5 or minus 7. The answer is, that is the first price available on Sunday at the open. You were filled at the first price that was available at that level. So you thinking you have a nice stop in place and carrying stuff over the weekend is crap. If this has never happened to you, I applaud you. If you thought about carrying trades into the weekend, this is why you do not. You don't know what's going to happen with the economy the way it is. You don't know if they're going to raise the debt ceiling, lower the debt ceiling, fire the president. You don't know what's going to happen. You don't know if there's going to be some mass exodus in the Eurozone to get out from underneath the euro and there's burning and buildings collapsing over there. You don't know if there's going to be an earthquake. Market makers use that crap as the opening reason to gap the market aggressively against you. It's crap, but it doesn't give you back your lost equity when you hold a trade over Friday. I've seen gaps come all the way back to the low. I've seen sick stuff with the gaps. So what I'm telling you is, in not so many words, is don't carry trades from Friday. Take what's given to you and get out. Okay, now, here's a typical week. This is the structure that you need to memorize to understand the week. Here's what happens. You know I have the small pattern that I draw for you guys, right? The week is comprised of the same pattern. Why, you ask? The answer is because the behavior is the same on the larger time frames. So the market maker's counter to your behavior has to be the same. So what happens is this. Remember I drew this for you? I don't know if you can see that purple. Stop, hunt, high, drop, pull back, right? That's the intraday pattern as I've illustrated for you before. I'll do it again in a minute. Stop, hunt, high, drop. Now on the bigger picture, consolidation, stop, hunt, low, trap lower level shorts, trigger the stops of the weak long holders, run it up, a big fat M, which is a multi-session setup. By the way, the most powerful setup is the multi-session M and W. What is that? I'm going to show you pictures later, but here's one for you right now. The definition of a multi-session M or W is simple. Market makers hit a level, They repeat the level in another session or another day. This example here is Wednesday. Market makers made the high of the week, the HOW, the how, right? They came back near the HOW, but failed to break it because they had trapped volume or pendings at that area that if they come back and repeat the level, the traders are released. Okay? What the hell are you talking about? They release the traders. How many times have you been in a trade and said, if it gets back to break even, I'm getting out? If it gets back to -5, I'll take my lumps and get on with my life. How many times have you said, if it comes near where I got in, I'll just take what I can get and be happy I didn't blow my account? If you said those things to yourself, you're not alone. This typical M&W behavior is based on that mentality or psychology. The traders that think like that because they don't understand the market put their pending orders in around here to get out at break even. They'll put their take profit at +1, 0, -2 just to get their money back and be out. When market makers come near the level, they don't allow that volume to be released back into your accounts. They don't want to release it back into the wild. Think for a minute. If there's $500 million at Wednesday's high or the high of the week, they're not going to break the level. They're going to come near it because, remember I told you they're so greedy, they got to grab whatever money's still there, and then they'll shift away for 3 days. The market is based on a 3-day, 3-level cycle. Write this down. The market is based on a 3-day, 3-level cycle. Market makers will trap lower level shorts, higher level longs, and make a unidirectional swing for 3 days. Or 3 levels. If you look at this example that's up there, you have a false move week beginning, which is a variation on the pattern. Stop hunt high. Coming out of Friday, which if you notice, this is exactly what happened this week. They hit it again Asia, hit it again London Open, bottom fell out. Okay? Now, they then repeated this behavior on a 2-day cycle. Stop hunt low, jam the traders, run. This run was made 3 levels or 2 to 3 days, approximately. The midweek reversal, which there's a midweek reversal almost every single week. You can have multiple levels in one day. Yes, that would make it a 2-day cycle. Now, Wednesday, they put in the midweek reversal like clockwork right here. They trap for the high of the week. They repeat the level but fail to break it. The spread opens up to pick up any pending orders on the other side of Wednesday's high or the high of the week. If you notice something, the highs of the week will coordinate with the stop hunt triggers at the beginning of the sessions. Think. This is a stop hunt high trap for London. They repeat the same stop hunt in the U.S. session. 2 sessions formed out in the middle of the week at Wednesday after 2.5 days of rise at 3 levels looks like a midweek reversal to me. You then get a unidirectional swing. Unidirectional meaning one direction. A unidirectional swing for 3 days. My friend David Gian and Bruce from New York would have caught this as a swing trade and maximized their gains looking to exit this trade Friday U.S. session. Why? Friday's the last session of the day. We know the low would probably come in between 9 and 10 or 9 and 11 in the morning. At the session changeover, the reversal comes. So we look for the low of the day, London, to look for our exit. We get the spike, a repeat of the level, and into consolidation to end the week. If you are a swing trader, that is your exit. Level 1, level 2, level 3. 3 levels of drop, spike the low, end in consolidation, lights out, a couple hundred pips in your pocket. The pattern that I'm going to draw for you and illustrate for you is observed intraday, intra-session, and intra-week. It also plays out on the dailies and the 4-hour chart. But for our purposes here, we're looking for intraday swings and spot trades only. This information will help you in your larger term charts and any other market. That stuff can be traded. Okay. Here's a typical weekly market structure, as I've just discussed it with you, but illustrated again on a different chart. False move week beginning. Spike the low, spike the high, into consolidation. Accumulate and evaluate. Market makers accumulate and evaluate. I hit the high, hit the low, picked up some pennies. What do I got? I spiked high again. What do I got? I spiked low. What do I got? Accumulate and evaluate. Steve, what are they evaluating? How good of a trader I am? No. They're evaluating the contracts and the money. How it's straddled over their spread. That's all it's about. The business is about the money. Now, you have a false move, spike the low. The V3 is vector 3 candles. I'll talk about that in a minute. There's the big fat W formation. Spike the low, pull back, hit it again, jam up the traders, validate the short sellers. Averages are open. This is a down cycle in any other textbook except mine. Straight rise into consolidation. Stop hunt low, rise. Next night, stop hunt low, rise. Next night, grab some pendings, stop hunt low, rise. Rise big. 33 trade, another trade we're going to talk about. A 33 trade is a setup. I'll lay the rules out for you. On day 3 of the 3rd level, you have an intraday 3-level rise. That trade will absolutely lead to a reversal. Think about from the market maker perspective for a minute. Every time a retail trader buys, a market maker must in fact sell to him to provide the liquidity. They are not pairing you up, Lou, in New York, with Abo in New Jersey. They're not doing that. They are managing their risk by offsetting that by taking some buys and some sells to manage their risk. But they are not going, oh, let's see, Lou wants to go long. Let me find Pete in Southern California. Looks like he's a seller. Let's match those two guys up and let them hold hands and go against each other. That's not what's going on here. That is a marketing ploy, and it is pure bullshit. Excuse my French. The dealer, the reason you get filled so quickly, the dealer takes the other side of the trade. He has some shorts and some buys. That's just the way it is. The short sellers offset his open long equity. The long holders offset his short equity. It balances. Thanks, Russ. Forgot what language it was. Okay, so now, keep in mind the 3-day cycle. day 1, day 2, day 3. You have 3 levels of intraday rise after the stop hunt. The reversal is imminent. I just was talking about market maker's equity. He's not unlimited. Here's what he does. You're a retail trader. You buy. I sell to you. Day 2. You buy again. I sell to you again. Day 3. You buy. I sell to you again. I look at my books. I'm like, I'm getting a little low on equity. I need to get some back. You're net long as a trader or as a collective group of traders. Market makers are net short. How do you get paid on net short? Correct the market to get your money back. On aggregate, at level 3, market makers go the heaviest. On the retracement, market makers are rewarded and pocket their money. And the cycle repeats. Okay, so now look at the week. False move week beginning, trap the traders. Evaluate. What do we got? You know what? The averages are showing down. We got some traders trapped long. We're net long right now. Let's make the false move, induce everybody to go short. What is perceived in the marketplace from retail traders as momentum is actually, and has always been, the move by the dealer to trigger the stops. When you see an aggressive move quickly and fast like that, that is a move to trigger the stops. It is done on less volume, and it gets the traders. Look at this from a technical standpoint. Cover that. This is what you have in front of you. You have an aggressive vector 3 or 3 candle aggressive move down, momentum. Breakout traders might have been rewarded on this deal because it's a 100 pip drop. The averages are open and crossed down. That's a technical short. Everybody fell for this. Market makers applied the brakes. Lower level short holders snatched it away, went into consolidation in here. That consolidation at the lower level builds short contracts from the amateurs that sell the rises in a downtrend, sell the rallies in a downtrend. That's how the textbook goes. That move, selling the rises in a downtrend, jams up the majority of retail traders short. Now, remember I told you there's a trade designed to get everybody in margin trouble and to keep them jammed. That is called a straightaway, and it comes out of level 1. It is right here on the chart. Okay, see the marking? It's right here. Here's what happens. You sell the rallies in a downtrend, you sell the bounces off the moving average, right? Not understanding the cycle. These are short move continuations for retail traders. Short move continuation for retail traders in here. They have some number of people in margin trouble right there, and some number tracked. Those traders are now stuck. Market makers are counting on you to make an irrational decision. The irrational decision being, lift your stop, scale in the wrong way to a contract, add orders to it, average down, average up, average sideways, whatever the hell you want to call it. They're counting on this. They then, at the beginning of the Asian session, shift the zone away from those traders quickly. See it? 4 straight rise green bar. They then go back into consolidation to accumulate more short selling. They push down, but they don't go past all these levels. They don't go past the levels because it releases the short traders that want to get out with +1, +5, +10 and get their money back that have been down all night. What's anticipated at a level 1 after an aggressive W formation is a straight rise. This is the day that most of the breakout traders will get rewarded This example, they threw a small stop onto the low and stopped out the short pendings. But the long pending side was rewarded. And if you notice, when they come out at London, it's a monster move, straight green candles right out of the box. Why? The aggressive behavior gets everybody into a panic that is net short. Or in a short position with multiple orders or big contracts or whatever you're trading. That aggressive move, pulling away from the low of the week, pulling away from the low of the week, jams all this volume in here. And jams them up. Some people are asking what DNC is. It's a new term. It's just simply what I say, and I wanted to remind myself of that. Thank you, Whitney. Do not counter trend trade coming out of level 1. Do not counter. Countering coming out of level 1 will jam you up. Because we expect straight rise. Because market makers got to get those contracts and hit the triggers of the people that are stuck. Don't counter. That's the place I don't want you to counter. Anywhere else, it's okay. When I say counter trend, I mean counter trend, market maker trend. Okay? Next night, we expect this. Stop, hunt, low, rise. The next night, we expect this. Stop, hunt, low, rise. They tricked you out with a little false move. But you got your stop, hunt, low, pins to the mayonnaise, rise. Notice how when you get to level 3, after the rise, the big candles or the aggressive stop hunt candles turn to the top side, here and here. They are now trapping long holders. Understand? They are trapping traders long now. You guys just hang in there. Just write down mayonnaise. We'll talk about it. As a trader, had a Diet Coke, sip of Diet Coke. You got to understand how to read the moves and understand what's going on in the market. Where the trap volume is, what the market maker is doing, how he's jamming up the traders. That is why it is not necessary to analyze your charts all the way back to Kingdom Come in February of 1907, that people that follow technicals do. Reading the market maker over the last 3 to 5 days at the course of a week will give you a directional bias, identify where the volumes are trapped and where the retail traders are stuck, and you will have your directional. Identify the midweek reversal. Tuesday, Wednesday, or Thursday, it's coming in. Midweek, Sunday, Monday, Tuesday reverse. Wednesday, Thursday drop. Rise Sunday, Monday. Make a big fat M. Drop Tuesday, Wednesday, Thursday, end Friday, and pull back. This is the cycles you have to be able to walk up to a chart and identify. Our group of traders that understands this saw the sell-off coming when they hit the high 3 times on Sunday night going into Monday. When market makers take the trouble to go back a 3rd time to a level and don't break it, the correction is imminent. When market makers go back a 3rd time, repeat the low of the day, the rise is imminent. They didn't go back to the level because they felt sorry for you and wanted to let you out of your trades. They went back there a 3rd time because there was so much freaking money down there they couldn't stand it. They had to come back and grab it. If you understand that and start understanding the other side of the chart, not the side that you see, the side that they are showing to you, and start to think like they think, you will start to have success in the business. And if you get it quickly, a light bulb will go off. It'll be almost immediate. You must anticipate when and how these moves will present themselves. The timings I'm going to talk about, the session starts, session ends, the Brinks trade. I will cover all of this for you. You can truly beat the market maker by simply trading in line with his behaviors. For you new guys, because in the session changeovers, we anticipate a reversal, New York reversal, part of the cycle. I want you to start to look to take your profit. If you're a London trader, you need to enter in the London Open and be out by the end of the session. If you're a New York trader, I want you to look to make your entry between 8 and 11. 9:30, we'll talk about that. Look to be out by 12, 1 o'clock in the afternoon. When your take profit is hit, or when the market comes to rest into consolidation to trap the traders for the next day, you take. If a trade does not see substantial profit in 2 hours, take your profit or a small loss. This is not negotiable. Why? If you see a perfect W formation or a setup, and it doesn't move into profit within 2 hours, upon further analysis by the market maker, the contracts were not straddled in the configuration that he had hoped for. This lack of configuration forces him to hold the level beyond the 2 hour mark to accumulate. The accumulation phase on an extended period of time could lead to another stop hunt against the original position you thought you had. Correct. Save yourself the pips. Take a -7, +5, +2, -3. Scratch yourself out and get on with your day. Example. Level 1 consolidation. Okay, we had a three hit to the high in the GBP crosses. They went high one more time at the London Open to validate the long holders, to make them feel good about themselves, warm and fuzzy. The bottom fell out. Today, they showed what appeared to be a W going into the red box. There's no chart up here. I'm talking. Take notes. Market makers extended the consolidation zone and did not rise much off of the low today. They then hit it again. Why? 3 levels wasn't seen. They needed one more hit to the low to hit their goals, to reach their targets. Sam, nice to see you in here, buddy. If the second leg presents, let's say you took a V bottom. Let's say you took stop hunt low, 3 candles to the low, and it pulled back, and you took that trade. If you're in that trade and you're counting 2 hours, and say an hour and 45 in, it paints a second leg, and it pulls back, restart the clock. The 2 hours is not negotiable. Don't come back and go, oh, I waited 5 more minutes, because I don't want to hear that shit. If they don't move in 2 hours, the criteria or setup for which you took the trade is broken down. They got something else going on. Their contracts aren't straddled right. They're going to make another stop hunt or a move. Sometimes you'll take it off and you go, damn, I had it right. Sometimes you'll take it off and go, oh, it stop hunted again. The reason for our setup or the criteria which you took the trade on is now broken down. It becomes a 50-50 gamble. We are not in the 50-50 gamble business. Go to the nearest Indian casino if you want to gamble. Your job is to take high probability setups based on market maker behavior. He shows you an action, you react to it.